Hey, good evening, everyone. Marty Missouri here, November 11th, 2022, with your weekly economic update. Almost wasn't going to do one, as I said in today's earlier video. This one was so interesting, though, and I did find time to get it done. Interesting in terms of where the positivity showed up in our index. As you can see here, we're getting close to the zero line, right? And the zero line separates expansionary conditions as we see them and contractionary conditions. And the way I like to say it is that when we're below zero, odds favor recession going forward as opposed to continued expansion. Still our base case, but our base case also says that whatever recession, if indeed we have one, that we have will be mild by historical standards. So let's take a look at these inputs that I selected out of our 45 to share with you this evening. We'll start with consumer sentiment. The University of Michigan survey was actually released today. That's the one in the second panel here. And as you can see, it dropped notably from the relatively low score of last month. And that's after actually rising for 4 months in a row. And it's just not far off of actually its record low that it hit here, mid-year. One-year inflation expectations, and this, mind you, is what the Fed is very kind of focused on, actually rose to 5.1%. That's just 1/10, but it's still a 4-month high. The 5 to 10-year outlook rose also by 1/10 to 3%, which is a 5 months high. Those who said that it's a good time to buy a home dropped by 10 points. Those who said it's a good time to buy a vehicle fell by 4 points. Spending intentions on major appliances dropped by 19 points. So you've got, weakening conditions, more or less red flag recession. At the same time, higher inflation expectations. So not a good mix when you think about consumer sentiment. Initial jobless claims ticked up last week, as did continuing claims slightly. This came out on Thursday, the same day CPI came out yesterday, and we're going to talk about CPI in a second. So those who are looking for the Fed to ease off the pedal a bit would like the combination, I guess, of higher jobless claims and lower CPI. The small business survey from the NFIB came out this week. The overall optimism read dropped to 91.3 from 92.7. According to the report, owners continue to show a dismal view about future sales growth and business conditions, although they're still looking to hire new people on balance, although less so than the previous months. Supply chain disruptions and labor shortages continue to limit the ability of many small businesses to meet the demand for their products and services. Expansion plans or CapEx plans scored lower as well. So certainly not a rosy picture in terms of sentiment among small businesses. And then on that CPI print, year over year dropped to 7.7% from 8.2% the previous month. The monthly increase, and this is what you really want to look at. The yearly increase is obviously going to be impacted by base effects. What happened, this month a year ago, as opposed to just what was the increase or decrease on a month-on-month basis. So that's more of the real-time picture of what's really happening right now. So 0.4% was the same, but the core, when you X out food and energy, 0.3 was notably below expectations. So folks, this gives you a feel for what inspired that monster ramp up across equity markets on Thursday. I mean, it was huge. Okay, so copper, this is that very busy chart. Let me just move one of these out of the way. Way back when, I was talking about the huge influence that China has on copper. I'll clean up these annotations. But of course, this last week, there's just a big ramp up in copper. And that is very bullish when you think about the global economy. And yeah, it's about China, right? It's about China. These memos that were released last week about this committee that's been formed to figure out how to get out of the COVID zero. And then the government pushed back, although this week we saw actual measures that were taken to alleviate some of these restrictions. And that was very bullish, right? And so that, I think, largely was what today's rally was all about, and has been very bullish for copper with the prospects of China coming back onto the global scene. Okay, so this is what moved the needle higher, is these last three inputs that I'm going to show you related to just market dynamics and signals from the securities markets about what's going on in the economy. So the number above 100 illustrates the extent to which a sector has outperformed the S&P, below 100 underperformed. So this is the tech ETF versus the S&P 500, 101.6. Financials, 103.9. Consumer discretionary is the one outlier, notably underperforming the average over the last 30 days. And of course, we had disappointments out of companies like Amazon and so on. Materials, however, huge outperformance. Energy, huge outperformance. Industrials, huge outperformance. So your economically sensitive sectors, with one exception, have been notable outperformers of the S&P 500. And then your defensive sectors, economically defensive, the safe havens, have underperformed, right? So 98.9 for staples, 98.9 for utilities, and 97.4 for healthcare. So that suggests that market is leaning towards, no recession, or at a minimum, our mild recession thesis. The S&P 500 Treasury bond, we use TLT, the 20-plus year Treasury ETF ratio. Here it is, coming into the 2008 disaster, bonds outperforming stocks. So when this is declining, the S&P is underperforming Treasury bonds. And so you can see that going into corrections and into these bear markets. And you can see it just absolutely ramping up big time here. So I wanted to show you this. I've been kind of taking this one to some degree with a grain of salt because of the inflation and the rising interest rates. Stocks and bonds have both been ugly. So it's hard to say, stocks are a great place to be because they're outperforming bonds. Just the bonds have been so epically ugly, the worst year ever, frankly. But nevertheless, I don't think I should completely discount the signal, despite the unusual inflation and what the Fed's up to and so forth. And then this one just singling out the staples and the discretionary ratio. So when this is rising, staples are outperforming discretionary stocks. When it's falling, they're underperforming. And you can see very dramatic move just here over the last couple of days. Now, the question is this really that much of an economic indicator right here? Or is it simply dramatic rotation out of the stuff that's been outperforming this year and into the stuff that hasn't? And in fact, we had a very good day in our core allocation today. However, staples, healthcare, and utilities all rolled over, notably. So they were down in not small fashion while the rest of the market was up. So again, right now the PWA index is pushing back really close to the flat line. And this week it was more about inter-market relationships than it actually was pure economic data, which really wasn't so good on balance. I'll leave it there, folks. Thank you, as always, for watching and listening. Hope you have a great weekend. Be back at you next week. Take care. Bye-bye.